And that's one of the reasons why, we've always wanted to sort of remain independent, both from the public markets and the institutions, because it's really not how this company has really been successful in buying property. It's being agile and shifting from asset class to asset class. We were chatting just before we started about, everyone was afraid of retail when it was, Amazon, the online effect. But now it's office. Yeah. And so because of remote work. So the markets change. And so being agile is huge. So, in that period of like 2009, it was a freeze. I remember sitting in an acquisition meeting in 2009 here. And Francis saying, and the acquisition people tend to get frustrated because they're transactional by nature and they want to buy deals. But the market hadn't reset yet properly for pricing, in our view, in a large way. So Francis said, look, let's spend time getting the house in order and button down the house. And, there'll be a time where, we'll be ready to start buying again. That's really what happened. And, that fed into our fund because what we wanted, and one of the reasons why we designed that first fund, which we called like the TEI Diversified Income and Opportunity Fund, one, because it was exactly what that long
diversified income
the title is. Yeah. It's a diversified pool of income and opportunity assets, but it was diversified. And it allowed us to sort of go where the opportunity was. And so that was the beginning of us sort of telling the financial firms that, we've been here a long time. I remember we developed a track record, and this was 2012, and I said, let's put a track record together and publish like a track record because, many firms don't have that. And we have the benefit of being a firm that was founded in the mid-'60s and very successful. And
historic,
I remember going back and saying, well, how long do we have to go back? And we picked 20 years because if you look at the date, it was basically 2012. I said, let's go back to 92 because I knew I couldn't actually track down the information in the 80s. Like it would have been like not. And we said, you know what, 20 years is enough. But now people are like, well, why did it stop at 20? Why did you go back to 1992? I'm like, well, that was our first fund was moving in that.
Sure.
And I said, let's put a track record together. It was really that. It's been an interesting ride in that way. And now when I fast forward, we're on Fund 6. And there's been a lot of offshoot businesses. We accelerated, the fund business accelerated as people got to know us. And a lot of offshoot businesses came out of it. We have, I'd say, one of the major businesses that came out is 1031 exchanges in a customized way. And we knew that business very well because we do it for our own account.
Sure.
So we expanded that business. And now I would say today that business accounts for at least half, or I would say more, than what our traditional fund business is.
Yeah, I want to break down that 1031 and then a couple cool things about the funds to highlight too that stand out after kind of picking through each of them. Was the first fund, did you raise 17 million in equity, or was that the total? Because that's what the number says online. Or was that the asset purchase?
Yeah, so no, it was all of our funds really just raise. We offer, when we buy a $25 million office building, just throwing a number out. $5 million might come from our funds. $5 million or $10 million might come from exchanges. $5 or $10 million might come from the principals of the firm. We might be doing our own exchange, but internal capital.
Got it.
It's a series of different, could be some of our direct investors. And everyone's sort of taking a piece of the pie. So when we raised like our first fund, no one knew us. So it took us 6 months, 9 months, 12 months to even get on everyone's platform.
I bet
that you could even allow, where they could allow their brokers or advisors to actually sell our product. So that was a process. Once you sort of were able to do that, you would then get referred to another broker dealer and another broker dealer. It was all about awareness. So what we were offering was, we raised like 17 million in that first fund, which I know sounds small in context to this size of this firm, but that 17 million had the ability to invest $1 million in one deal, $1 million in another deal, $2 million here. So it's got 20 or 30 assets in a diversified way. So it's almost like a little mini real estate investment mutual fund in some ways.
Yeah, 100%.
And that was sort of like, and again, that was represented just a segment of a business that we were really fostering to build up a distribution channel so that we weren't over reliant on principal capital of the firm or one major partner that would dominate the capital structure. So that's been a very important feature that we've been able to maintain that ability. And we had less pressure because, it was very, for me, someone who was heading up capital, it was nice to be able to go in and sell strength because I wasn't really focused on the amounts. I was focused on awareness.
Sure.
And getting the right people and knowing that we could do it in an authentic, sort of honest, transparent,
to represent time equity,
integrity way. And that, I always tell people, still to this day, I tell people to this day, I said, we want the money, but we don't need the money. And so when you're raising money and you mean that and it's real, it's a huge advantage because you're basically not making decisions based on the capital, which a lot of people, experienced real estate investors, tell you that's where you make mistakes. And that you have to stay true to your investment principles and your philosophy for buying and owning and managing and being upstanding citizens and following the code of law. So those are things that I was able to do, and it slowly, just one by one, got traction, and I started building a team. And
it's worked out pretty well.
Yeah, it's been great. It's been great, and now, you fast forward, and $1 billion later,
I would say,
of capital.
So as the funds kind of evolved, so the 17 million was the one raised. I think Fund 3 was like 67 million, and then Fund 4 was 127. So like you guys started to really pick up speed quickly, which I found unique. But then also the percentage that you guys co-invest is like between 30 and 40%, which seems staggeringly high for a sponsor or someone putting together the fund to do. So like, I wanted to ask you that when I was prepping. What's the importance of that? Do you think it speaks so highly of the fund? Also, you guys are generating a good return from that. But like, what's the importance of you guys seeding the deals with 30, a third of the capital on your own?
Primarily what it really is that we're investors looking to make good deals.
Right.
And that we really want, and our objective is to attract investors that can be aligned with us and to treat their capital the way we're treating our own. And I would even make the argument that we're more conservative with investor capital than our own capital, in the sense that we'll take risk, but not necessarily offer to our investor base until we feel like we understand the risk in a way that's manageable.
Sure.
Meaning going into a new place or a new country of some kind. Yeah. And I can give you a couple of examples of where that happened. But the co-invest is meaningful, but primarily it relates to the simple answer is that we're investors and we are looking for good deals. And if it's a good deal, we want to invest in it.
Sure.
And we're really inviting investors to join us as opposed to find a grouping of investors and then go out and find the deal. So we're finding the deal and buying the deal either way. And I think that became a very attractive feature for people because people could identify with us as co-investors and we're in an alignment,
right?
And that we weren't just trying to sell them something. I mean, we go in a contracted deal, we do due diligence, we're doing it anyway if it meets our tests, and if it's not, we're not buying it. So, and I think that today it's been a very important component of this firm's success. But knowing that you're managing it and that we're aligned on our structure and how we participate, it's all predicated over preferred returns. That we're really in the profit business. We're in the business of properties going up in value and building cash flow. People ask me like, how would you describe like what Time Equities does? I'm like, we're in the real estate accumulation business.
It's a good way to
we're
put
just
it.
accumulating, and it's that really what we're trying to do is build up cash flow in a series of properties that are not connected to each other. And one of the advantages with the way our system is built is that every single property is owned in a single purpose LLC, every single one.
Wow.
So nothing is connected to each other other than common form of ownership, meaning the fund at the parent level is consolidating and has ownership interest in various deals. But it's not as if one bad apple can spoil the bunch. And that is different than the public markets, or even some of the institutional funds, because you can isolate a problem.
Yep.
And it doesn't impact necessarily it might impact the overall strategy of how a fund might perform, because
But it's not
netted
spoiling
together.
the fund.
It's not
right.
spoiling it.
Yeah. So as far as grouping of the funds, as you kind of pick through 1 through 5, right? Funds 1 through 5, and you see it almost like there seems like different strategic concentrations, right? That each fund may have. Like one fund seemed very Central East, and then some maybe Northeast, and then West based, and then you start to add international as well. But so the products changed over time too. I think in Fund 5, you started buying distressed debt, which seemed different for you guys. So I was curious, do you see an opportunity in this market with a lot of these loans coming to maturity? Like how do you decide kind of what goes into your mutual fund or this like collection deal by deal?
Because we're out there just looking at opportunities and we're offering our investors what we think is interesting at that time. And because these funds, what we typically do is we have a 2-year fund.
For the raise?
For the raise, but we're buying along the way. And then once we're done, meaning Fund 1 ended at December of 13, and it has X capital, but it doesn't mean that it won't continue to buy, because some of the properties we would buy all cash, and then we would put financing on, and then that would be Fund 1's money, and we'd go and buy another property.
Huh.
But primarily, the strategy only changes per each fund based on what we're focused on during that buying window and where the fund has cash.
Right.
When the funds got bigger, obviously the diversification became more, we became
broad,
wider spread.
Yeah.
But, as an example, when we were buying internationally, we started buying more actively internationally in the last 10 years. But in the beginning, we weren't sure how investors would feel about that. But then we sort of said, well, what if we just capped it as a certain percentage of what the fund could invest?
Oh, interesting.
Meaning, if we think it's a good deal to buy, we want to be able to offer them everything that we think is
a good deal,
worth buying, because we don't want to cherry pick it. It's actually the opposite. We want to be able to offer them wherever our strategy is at the time. And because our strategy is agile and moves and is opportunistic, it changes. Meaning, based on what is available at the time, how the market's pricing it, where relationships come from. We have a lot of strategic partners,
I would say,
throughout the U.S. and Europe and Canada. And so it changed only based on, what capital was available at that time and where we were capital-wise and whatnot. So it's actually very consistent with us just continuing to expand into new asset types.
Yeah.
So international became something that is now integrated into all of our funds. It's just in the early funds, we weren't actively buying as much, and we weren't sure. We were new to the broker-dealer channel. We didn't really know regulatory-wise how people would feel about it. But in the end, they actually were buying into us as investment managers.
Wow.
I always say what I would see a lot when I would go out and speak on panels and go to conferences and talk to people, I would see a lot of times that the mistake the investors would make is they'd pick the wrong jockey. And that, they would focus on sometimes
the horse too much,
deal more than the manager. And, our strength is the infrastructure, the strength of the company, our network, our financial capabilities, our experience, our people, our reach capability, the fact that we're in all these markets. So that's where I think people started catching on. That, you're actually with us investing more in our funds, the broader context of it. As opposed to a given deal. Now, when you get to a 1031 exchange that has to go into a specific transaction, that's a little bit different. But our funds are primarily guided towards growth, tax benefits, appreciation over the long term.
And so buying them at all at good prices.
And so we would add international. We started adding debt. It wasn't only buying some distressed debt. It was really going into B-note positions where we would lend in a B note, and we would get comfortable with the asset value. And it was something that I had been trying to get Francis to think about for a number of years previously. He never really has that mentality to be a lender. He thinks equity, the core of this company is to own and operate and be in control of your destiny. And lending is very different in that way. But there's good yield. So when we had more capital, the other thing that became clear is that we weren't going to force deals because we had capital.
Right.
So how do you get the capital out?
Yeah.
And in the funds, you're paying a preferred return on it on an annual basis. You're sending out quarterly distributions. Yeah. It's not good with the money sitting at the checking banks and sitting there earning nothing. So you have to sort of move with the markets, and I can tell you how that correlates to today, which is the reverse of that.
Yeah.
That the equity, in my view, is out of favor relative to what you can get from the banks. Because the market hasn't fully repriced yet, and you can get debt instruments in some ways are more attractive unless you're talking about buying opportunistic pricing. So when we started doing the debt arrangements, it was just a way for us to organize capital, get low teens returns, and keep the money working. And if we got paid off, we got paid off, and it was a good transaction. But we always got comfortable, and this is a scenario that just recently happened, where we foreclosed on the developer.
Oh, wow.
Because they, so we got comfortable with the basis that we were lending at.
So you're lending as if like you feel comfortable owning the asset at that basis.
Yeah, we won't lend on something that
at
our basis, if we had to own it, we're not comfortable owning.
That makes sense.
And so that was our risk protection, quality control.
Wow.
And so it actually, on a large property we have on the West Coast, we actually never really envisioned
worked out.
Like a Class A multifamily.
Wow.
On the West Coast. And we didn't plan on owning it. We planned on getting
Lending
paid off.
on it. Yeah.
Now we own it. So.
That's cool.